commentators only step in if we believe there are signs that the way pricing is created may be impaired by illegitimate activities or certain activities which may fundamentally impair market confidence in general. That level has to be reached. If it doesn't reach, there can be quite extreme volatility. That per se would not trigger a regulatory activity on our side.
They're worth pointing out to the audience, we're counting down to the start of the session for Europe and what we've had over the weekend. Incredible moves in sterling, right? But last week, we didn't get too much on FTSE.
No, well, we are looking now at a positive start to trade this week. Of course, a big week for earnings in addition to Brexit and those headlines around U.S.-China trade, which at the moment are supportive. We'll be right back with all the opening numbers shortly.
Teaching shapes lives. If you're thinking of becoming a teacher, our expert teaching advisors can give you the level of support you need to get one step closer to the classroom. Teaching. Every lesson shapes a life. Search Get Into Teaching. Advisor support subject to eligibility.
We've been together 3 years. We both love travel, and luckily we've got the same taste in music. Next year, we're planning a big road trip, and my wife's coming too. It'll be nice. The three of us don't do enough together. We know how much your Mini means to you. That's why Mini Service offers an array of convenient options and allows you to book online anytime at mini.co.uk. Because we love your Mini almost as much as you do. Search Mini Service. Who's in? T's and C's apply, subject to availability, participating retailers only.
She did it! Her first word! Listen, everyone.
Mama.
Oh, she's lovely.
Mama.
Oh, did you hear that?
Oh.
Savings. Savings account.
Teaching your kids how to save may not be this easy, but you can get them learning good habits and skills from an early age, thanks to the range of children's savings accounts from Yorkshire Building Society. Just another example of real help with real life. Find out more at ybs.co.uk.
London, switch to Vodafone, the UK's best mobile network, and Be Unlimited, because the best phones deserve the best network and our new unlimited data plans. The future is exciting. Ready? Vodafone.
Max download speeds apply to unlimited data. Best network as voted by readers of trusted reviews. Terms at vodafone.co.uk/unlimited.
I need to get to Birmingham in exactly 1 hour, 22 minutes. But how? A chair? But rocket-powered. Is that a thing? A chair on rockets. On rockets! A big fat rocket fest! Does sound a little dicey. Okay, how about a nice comfy chair on lovely sturdy wheels? Yeah, on super fast tracks. Double yeah! And, wait, is it a Virgin train now? I suppose it is. Well, good. I'll do that. Virgin Trains, London to Birmingham in 1 hour, 22 minutes.
And to say happy birthday, we're giving you a pair of award-winning Silver Galaxy Buds.
But it's not my birthday till June.
No, but it's ours. 10 years ago, we launched our first Galaxy smartphone. And to celebrate, we're giving customers who purchase any Galaxy S10, Note 10 or A90 5G the chance to claim a pair of amazing wireless Galaxy Buds.
Wow, and I didn't get you anything.
Get the latest Samsung Galaxy smartphone now at your local EE shop or ee.co.uk. Offer available on purchases made by the 23rd of October 2019 and claimed online within 30 days. T&Cs apply.
European markets just waking up after what was billed as Super Saturday here in the UK. As Steve put it earlier on, it turned out to be more of a soggy, sad Saturday as the Brexit vote was delayed, and now we are waiting for clarity around the next steps. Sterling this morning trading lower in the first moves in reaction to Saturday's developments, but in recent trade has actually pared back losses. The market seems to be taking the view that a disorderly Brexit, the risk of a disorderly Brexit has been substantially reduced, and we are likely to see some sort of resolution that is supportive for sterling, supportive for UK assets. Now, Stoxx 600, the broader European benchmark, taking a leg higher this morning. It's trading slightly above the positive, slightly above the flat line in positive territory in the first moments of trade. Now, beyond Brexit this week, we're also keeping a close eye on U.S.-China relations, and the rhetoric over the last 48 hours or so has been fairly positive from both the Chinese and the U.S. side. So that's providing providing a boost for markets as well. And then, of course, corporate earnings sharply in focus this week. We had U.S. banks report last week, better than expected. Now in Europe, we're getting into full swing this week. So a lot for investors to digest this morning. Let's take a look at sectors and see what the split looks like. What's making up the modest gains that we're seeing on the Stock 600 this morning? So we're at the bottom of the board. We've got oil and gas, real estate, basic resources trading below the flat line. They're the worst performers of the bunch, but fairly modest in terms of the step down that we are seeing. Now, moving right along, we've got industrials, construction, financials, chemicals in the middle, really hovering around the flat line. So wait and see mode for those sectors. I'm moving along to the top of the board here. We've got banks performing very strongly, up about 0.7%. No surprise there. If I look at the top performers within this basket, RBS more than 2% higher at the start of trade. So a very strong bid for the UK banks, like we've been seeing for the last couple of weeks. Positive developments around Brexit means buy UK domestic stocks, home builders and banks. Let's take a look at the markets and see what the regional split looks like. We are seeing a red for the FTSE 100. Of course, that masks some of the more positive moves that we're seeing within the index. FTSE MIB over in Italy trading a touch higher, about 0.15%. Over in France, the CAC 40 is trading a touch below the flat line. So fairly mixed picture when you look at the different regions here. But I think the sector performance perhaps is the most interesting split to examine this morning. Let's dive into the FTSE and see what is making up the moves on the UK index this morning. So in terms of the latest, British lawmakers have voted to postpone a meaningful vote on Boris Johnson's new Brexit deal, forcing the UK Prime Minister to request a new delay to the October 31st deadline. Now, Johnson sent an unsigned letter to the EU requesting an extension, but also sent another letter arguing against a further delay. The government is set to push for another vote on the deal as early as today. And looking at the FTSE here, you can see that we are seeing a very strong bid for the UK banks. As I mentioned there, we've got Barclays trading about 1.15% higher, RBS 1.5% higher, Lloyd's trading about 1% higher. So quite strong demand for those UK banks. Now shifting gears, taking a look at UK home builders, another area we're seeing quite a strong bid. This is the picture for banks. And if we can just move on and take a look at home builders, here we are. We've got also a strong bid for these names. Barrett Development up of more than 1%. Bellway, Taylor Wimpey, Persimmon, and Redrow all trading higher this morning. We're seeing, again, I mentioned Sterling. The losses that came through late last night have been pared back. So quite a positive momentum trade coming through for UK assets. So with that, we'll hand it back to you guys over at the desk.
Thank you very much for that. Chris Irons has joined us, portfolio manager, Amity European Fund, Edentree Investment Management, and staying with us, our guest host today, David Marsh, chairman and co-founder at OMVIF. Welcome. Good morning. As you can imagine, we've been debating Brexit all morning and ramifications. So just weigh in with your view and the implications for investors at this point.
Well, I think the change from Friday to today doesn't seem to be that great. Maybe no deal Brexit is slightly further away. I think the probability is that although Boris didn't get his vote on Saturday, he will get the meaningful vote passed at some point this week, even if it's not quite as meaningful as we thought it was in the past. I think the market is reacting to that by UK domestics doing fairly well, less chance of a no deal, perhaps even more chance of a slightly softer Brexit as Parliament gives itself more of an opportunity to amend the legislation he's putting in place. So at the moment, it looks like the market's taking it positively, but we'll have to wait and see how the week progresses because some of these votes are going to be on a real knife edge.
Unfortunately, with Brexit and also with trade, there's an element of we've been here before, and you can see the response from some investors, which is to remain in the defensive category. Healthcare, for instance, is still the best performing sector on Wall Street over the course of last week. If you consider where we stand now, and if I look at your portfolio, you're focused on high-yielding cyclical businesses and defensive areas of the market. Do you think that the market's love of defences starts to alter if there is a Brexit outcome?
It depends on what Brexit outcome.
Not a hard Brexit, for instance.
Not a hard Brexit. I think it depends. The consumer staples have performed very, very strongly. It's not an area I'm currently invested in because they're real bond proxies and low risk. I think as you get greater certainty, the market will move into areas which are seen as risk on in terms of Brexit, happier with the UK economy. Now, this could include some domestic sectors which are very UK specific, but it also means bond yields coming up. So something like consumer staples is likely to sell off in that space.
Sets the scene for us. David, weigh in on this. So in terms of the investment theory at this point, because markets have traded one way, very much split between a little bit of risk and a little bit of safe haven in the portfolio. What happens if we do finally reach an outcome on Brexit? Trade is still in the mix too, with phase one being negotiated.
I think a lot will depend on the mood music coming out of the rest of Europe, because we will be then getting into a new period of very intensive negotiations in the next couple of years over the trade. And so the markets can, I think, put behind them this episode that we've had in the last 3 years in the UK. If out of the leading capitals of Europe there's some positive news about Britain, and I think there will be, actually, I think they'll be relieved, and there's a positive backdrop to the atmosphere for the trade negotiations. Also, we get a little bit of a positive spin coming out of the United States. I think that could together be quite a frothy, useful combination for UK domestic stocks. I would also buy a few stocks that might be benefiting from lots of people getting up early or staying up late to watch rugby games in the next couple of weeks. I think that might be my secret weapon as well to boost your portfolio. I don't know who's going to profit from that, but I would bet on the Rugby World Cup.
I think very much the UK market is trading at a discount to other European and global markets because of Brexit. I think there's a lot of overseas money which is probably sitting on the sidelines waiting to come into the UK. So that should be positive for UK equities overall. It'll be especially positive for the domestics. Clearly, ones with more international exposure are going to suffer if sterling strengthens. And I think we saw sterling strengthen a long way over the last week or so, but it could do that again. We could quite easily see another 5 cents in terms of the euro and the US dollar.
So we mustn't forget there will be an election here fairly soon. That will obviously introduce some further uncertainty. But beyond that, I'm not a huge supporter of Mr. Johnson, but I'm even less of a supporter of Mr. Corbyn. I think Corbyn will be out of the picture after the election, and that will actually be quite helpful, I would say, for UK stocks.
Chris, I want to ask you about a stat I read yesterday with regards to US markets, but I'm curious your take for the European side, that the overlap in US companies owned by both hedge funds and traditional mutual funds has climbed to a fresh high, suggesting that there's incredibly crowded trades going on in the US market. Do you think that's the same here in the UK, here in Europe, that we are seeing crowded trades? And what does that mean for risk when we look at things like profit warnings, earnings misses?
I wouldn't necessarily see it in that context, but I certainly think that some strategies seem to have done very well for a very long time, and it's created large differentials in valuations between different styles. So, the last 8 years has been very, very good for growth. More recently, it's also been very, very good for quality, which has benefited as being a bond proxy. And with those two sectors, you've seen momentum do very well as well. So clearly a lot of people are moving into those areas and they're becoming very crowded trades. Whereas on the other hand, value has been really left behind. It's almost a sort of forgotten strategy. But I think in the long term, if you're picking companies with very high free cash flow yield, very high dividend yield, and actually which are not structurally challenged, are going to continue to perform well in the long term, then in a zero interest rate environment, these look very attractive investment options indeed.
And we saw a bit of a taste for demand for these value stocks in September, where it looked like we were going to see a rotation out of these bond proxies that have done so well and outperformed value. Do you think this trade has legs, and what's going to be the catalyst if it does?
I think regardless of what happens over the long term, you're going to be better off being in value, high-yielding stocks, simply because you've got that very big yield advantage, which will give you great returns over the long term. In terms of the actual catalyst, you really need one or three things coming together, which are all really interconnected. I think the first thing is a decline in some of these geopolitical events, which are clearly having a negative impact on both markets and on the overall economy, which Brexit and Trump and his trade wars are the two major ones, although there are plenty of other instances as well. We can look at Hong Kong with the disruption there through the democracy protests. I think along with that comes, if we get past some of these geopolitical turmoils, the fact that we've got monetary policy now moving very much in favour of being supportive for growth, which it wasn't at the start of the year when they were normalising policy, so a better economic outlook. And then thirdly, when you start getting those interest rates, bond yields start to move up again. And I'm not, whereas I can't say it's going to happen in the immediate future. I think the conditions are in place for an improvement, even if at the moment we're seeing a gradual slide down in overall economic activity.
David, I want to get you in. Any warnings about high yield at this point? Because we've come a long way from talking about negative yields this morning. And just a reminder, going into the last crisis, you had companies granted loans with no collateral over a 5-year period. Is there a reason we should be cautious around high yield when everything else is so deeply negative?
I mean, the people at the BIS, above all, the real monetary conservatives have been sounding the alarm about this. There is a lot of froth. There are financial stability risks. I think the market is too sanguine, actually, about the outlook for easing. As you say, Chris, it looks as though monetary policy is being very accommodative, and the latest ECB actions have led us in that direction. I think the markets have failed to see that there is actually a case for some tightening. If Britain does leave the EU under good terms, then it could well be that the Bank of England is right, that the next move in UK interest rates will be up. It could be that the coalition, which is now been very much arrayed against Mr. Draghi within the ECB, will force Mrs. Lagarde to rethink the easing. So I think markets are wrong, actually, in pricing in continued easing, continued negative interest rates. I think there'll be a strong move actually in the opposite direction, and that could obviously hit the high yield sector.
Wouldn't that just be a jolt as a prescription that most fear, inverted yield curve to rising rates, and then comes the recession?
Yes, I think markets on the whole are too sanguine about that.
David, thank you very much. And Chris, we'll pick up in the conversation in just a moment. In the meantime, Julian's watching a key stock for us today.
Indeed. Let's kick off with Wirecard. Wirecard has hired KPMG as an external auditor to investigate alleged accounting irregularities. The Financial Times published documents last week allegedly showing the payments group fraudulently inflated its earnings. Now, the company says the audit will clarify the accusations, quote, fully and independently. And Wirecard shares are trading higher this morning on the back of that news, up about 4.6%. But still, look at how far we've come. Yet last week, we saw shares dip around 20%. So for the last 3 months, we are looking at a 21% decline. So clawing back some of those losses, but still quite significantly lower relative to where we were. Now shifting gears, let's take a look at SAP. SAP and Microsoft have reached a 3-year deal to help large enterprises transfer business content into the cloud. New SAP co-CEO Jennifer Morgan says the partnership will help clients run operations at remote servers supported by the German company's main database. The announcement comes after SAP posted third quarter earnings in line with expectations earlier this month and announced the departure of longtime chief executive Bill McDermott. Meanwhile, Microsoft CEO Satya Nadella hailed the partnership with SAP, calling it unique and extensive. AMS, meanwhile, has launched a fresh takeover attempt of Germany's Osram in a 4.5 billion euro deal. The Apple supplier has set the acceptance rate for the offer at 55%. AMS previously failed at a takeover attempt of the Lighting Group, falling short of securing enough shareholder support. And you've got AMS shares trading about 1% lower, Osram shares just a touch below the flat line, about 0.27%. Now, Berlin's government has agreed to freeze rents in the city for 5 years. The plan will come into effect from the start of next year. Housing costs have spiraled into the German capital in recent years, with rents doubling in the last 10 years. Property company Deutsche Wohnen is Berlin's largest private landlord, and you can see Deutsche Wohnen shares are reacting negatively to this news, down about 3.4%.
Coming up on the show, UBS Chairman Axel Weber speaks out on the spying scandal that has shaken rival Credit Suisse. That exclusive interview coming your way next.
Right now on CNBC Make It. Think you've had tough job interviews?
Whatever job you're searching for, you can find it on LinkedIn.
First jobs, flexible jobs, work from home on a Friday jobs, advertising jobs, accounting jobs, HR, PR, even ER jobs, Soho jobs, Shoreditch jobs. Keep me away from the central line jobs. Banking jobs, building jobs, never ever boring jobs. Small jobs, big jobs, London Borough Market jobs, or even voiceover jobs, which is how I ended up recording this ad. Search millions of jobs on LinkedIn and find one meant for you.
Why is Lizzie going rental for Fizzy Haze? Is it because her flat is so beautiful and spacious? Snazzy! Or has roof terrace, garden and party room? Surprising! Or because it's 18 minutes to Paddington? Easy! With friendly staff on hand to take any deliveries? Amazing! Or just because her fuzzy friend can live there too? Find your new home at fizzyhaze.com. Fizzy Living, reinventing renting.
They don't chant your name when you give blood, or sing songs about you. But patients and their families will remember you forever. Because your blood can change their lives. We need more blood donors in Tooting, the West End and Edgware. Bleed for London. Join us today at blood.co.uk.
It's time to do a bit of Debenhams with up to 30% off our favourite coats, knitwear and boots for the whole family and 20% off throughout home. Shop now, in-store and at debenhams.com.
She did it! Her first word! Listen, everyone.
Mama.
Oh, she's lovely.
Mama.
Oh, did you hear that?
Oh.
Savings. Savings account.
Teaching your kids how to save may not be this easy, but you can get them learning good habits and skills from an early age, thanks to the range of children's savings accounts from Yorkshire Building Society. Just another example of real help with real life. Find out more at ybs.co.uk.
London, switch to Vodafone, the UK's best mobile network, and Be Unlimited, because the best phones deserve the best network and our new unlimited data plans. The future is exciting. Ready? Vodafone.
Max download speeds apply to unlimited data. Best network as voted by readers of trusted reviews. Terms at vodafone.co.uk/unlimited.
You're watching Squawk Box. Iqbal Khan, who used to head up Credit Suisse's wealth management unit and was at the centre of a spying scandal at the bank, is now part of UBS's talent bench. So says Chairman Axel Weber, who told Jeff at the IMF meeting in Washington that UBS is just a recipient of a development at its rival.
This has been a Credit Suisse issue, and we did not come in the picture unless, in the end, until this, Iqbal Khan decided to move to another job. And with a larger bank in town, he was our auditor years ago, so we were unable to make him a job offer then. When he looked for a job now, we were able to make him a job offer. So I think we're simply the recipient of a development at Credit Suisse, and he's a talent. So we decided, in our attempt to bring the next generation of leaders into UBS, we had some internal promotions to the executive board. Suni Hartford is one example, but Iqbal was a talent that was on the market, and we always said, if there are opportunities to hire somebody from the outside to our executive team and it's a fit, we'll do that. So for us, it's part of the normal transition planning. What is important is to have a talent bench that is there to lead the bank in the future. And Sergio and I were very clear, these transitions we're making on the executive board and on the board of directors, it's going to be an orderly process over years.
Axel Weber there weighing in on the spying scandal. Normally talk about spying scandals, not from a corporate sense.
No, this was
state-sponsored.
It was hard to take your eyes off of this scandal when it was in the heart of it
Amazing,
all.
right?
Yeah, Jeff was over in Zurich.
Let's come back to the broader conversation we're having around the set. Chris Lyons with us, who is portfolio manager, Amity European Fund, Eden Tree Investment Management, and David Marsh, chairman and co-founder at OMFIF. One of the big focuses for markets still away from all the Brexit developments is trade. Phase one's been negotiated. There seems as though there's momentum on both sides to get some form of a trade deal done. What does that mean as we come up to year end?
Obviously, it's a positive. I think it's positive not only for the markets, which will react to that, but for the global economy. It's very hard for companies to make business decisions, investment decisions, when there's so much uncertainty. I mean, we've seen boats have to change direction in the middle of the ocean. So trying to put long-term planning into place when that's going on is very disruptive. But high tariffs is not a good thing for the global economy.
That's it. There's been very low volume in some of the days in the trading sessions in the States, which suggests that maybe investors are a little bit on the sidelines, as we also have market indices trading just off their peaks that we've had in terms of records. So if we get a deal, how much more upside is there? Is there sort of cash waiting to be invested?
I think there'll be an upside for cyclicals. Again, it's really that certain sectors have done very well. So the big rally in the UK and in most global markets has really been on lower interest rates. So people looking at bond proxies and pricing those up. If you have a situation where you have greater clarity in terms of the global economy, people are probably going to be more willing to invest in the cyclical side of the economy. So you could get quite a rapid switch around in terms of relative valuations between.
I think there's a couple of things I took away from the United States for next year, looking into the presidential election, is that one, Mr. Trump doesn't want to knock the stock market on the head, so he doesn't really want to damage the economy too much by something really draconian vis-a-vis the Chinese. Second, he doesn't want to go soft on the Chinese either, because it's quite a vote winner. And also the Democrats also are very confident of the idea that they have to punish the Chinese. So although Mr. Trump doesn't look like the man for all sorts of deft calibration of his strategy, I think secretly he is. He's going to go not too hot, not too cold, and probably nothing really will be resolved for some time. But he's certainly not going to knock the economy on the head with something really severe against the Chinese. So I think there is a positive updrift in what you're saying. I don't think we're going to see Armageddon breaking up between China and the United States. It's going to be a sensible deal, probably will be aiding the United States more than it aids China, but both sides at the end will be relatively comforted, and I think it's going to be positive undertone for the markets.
I want to pick you up on that point about President Trump being so cognizant of where stock markets are trading. And I'm just reminded of last year around this time, the Q4, obviously a very painful time for investors. President Trump seems to have been somewhat traumatized by that period. After that, in obviously the first quarter of 2019, we saw a major turnaround in the Fed. Now that as we head into year end, from an investment perspective, do you think that this rally that we've seen come together on the back of Brexit, investors are inclined to take profits on this rally, or do you think they're going to be brave enough to actually continue chasing it higher, given the memory of what we saw last year around this time?
Well, in some ways, I think it's the other way around. People are taking profits out of the rally that happened in the first 8 months, and the fact that we're sort of 8-10 years into a bull market for growth. I think there's every opportunity for value high-yielding stocks to continue to outperform, provided the global economy doesn't turn down too sharply. I mean, I think we'll be looking at some interesting results in cyclical companies over the next few weeks and seeing just how bad things really are getting. Clearly, the global economy has slowed, but to what extent? And to what extent is it only certain areas of the economy? I mean, at the moment, automotive sector looks very bad indeed. The German economy is suffering a lot from the slowdown in capital goods spending coming out of China. But the broader European economy doesn't look too bad. The picture in France, if anything, has improved over time, and there's a bit more fiscal support following the Gilets jaunes rioting in France, which made it more amenable to a softer fiscal policy. And I think the same is true in Italy, where the EU should be supportive of this new government, which